Welcome to another tutorial video. This one is going to be about cash-free, debt-free deals in the context of leverage buyouts and also M&A deals. And if you're paying close attention, you will have noticed that we have covered this topic before, but there were some issues in the previous version and the examples were not great. So we're going to present it differently this time around and make it easier for you to understand. We're going to start with a simple example and then build up to a more complex one here over time, and then also look at how this differs in the context of M&A deals, not just leverage buyouts. The common question that we get here goes something like this. What is a cash-free, debt-free deal? In a leverage buyout or merger or acquisition, does that mean that the target's cash and debt balances literally go to zero when the deal closes? And if so, how can a company operate even for a short time with a $0 cash balance? Because all companies need some small amount of cash to keep operating and paying the bills day in and day out. So how could this even be possible? If you want this tutorial in writing along with screenshots and all the Excel models that we're going to go through here, go to this URL. It's very long, so I'm going to pin this in the comments as the first comment here, but essentially go to our knowledge base under leverage buyouts and LBO models and look up the one cash-free, debt-free basis, or just Google cash-free, debt-free basis and BIWS, and you should find it like that. But like I said, I'll pin this in the comments and you can get all the resources here. So the short answer to this question is that in a cash-free, debt-free deal, yes, the target company's cash and debt balances both go to zero at the time of deal close or just after, but they are immediately replaced with new balances right after this happens. And people often leave out this part, and so they get a very misleading impression of what these deals actually mean. Cash is typically brought up to the company's minimum cash balance that is required for daily operations, because yes, a company might be able to go for a day or something like that with technically a $0 cash balance. But in reality, even for a short period, like a few days or a week, all companies need some amount of cash to keep paying the bills. The debt could go to the old level, or it could actually go to a higher level depending on the deal type. For example, in a leverage buyout, company's debt is repaid and refinanced and typically is replaced with a higher debt balance afterward. This is what private equity firms do in leverage buyouts. The name cash-free, debt-free deal makes it sound like this, where a company might have 50 in cash and 150 in debt. And then after the deal closes, the name makes it sound like the cash and debt simply go to zero. These bars simply disappear. But in reality, it looks a little bit more like this. The cash and debt do go to zero upon deal close, but then right after deal close, they're brought up. And the cash balance here is typically the minimum cash. So we could say that 20 is the company's minimum cash. And then the debt level here could be the same or could be higher. It could potentially even be lower, but probably in 99% of cases, it is about the same as the old balance, or in the case of leverage buyouts, it is actually a higher debt balance as long as the company can support it and continue paying interest on it. Now, the mechanics of this are as follows. Cash-free, debt-free deals, which are almost always used for private companies, are framed in terms of a purchase enterprise value, and that appears on the uses side of the sources and uses schedule. I'll bring up a very simple example right here. So this is for a private company LBO. You can see the purchase enterprise value as the first line of the sources and uses schedule. With the cash, right around the time of the deal close, the target company's entire cash balance is used to repay as much debt as possible. If there is some cash left over after that, in other words, if the target's cash exceeds its debt, the remaining cash is then distributed to the existing shareholders in the company. If there is debt remaining after that, then the repayment of this debt is deducted from the proceeds that go to the shareholders. So if cash exceeds debt, the existing shareholders get some of that benefit. But then if debt exceeds cash, then the private equity firm or the other acquirer still pays the same amount. It's just that the proceeds to the shareholders are less because some of them have to be diverted into repaying this remaining debt. It's important to note that in no cases does the acquirer actually pay for this remaining debt unless something very odd is happening with the deal structure. It's really the responsibility of the selling shareholders to repay the remaining debt in a situation like this. Now, for the sources and uses schedule, as I said, the purchase price is based on purchase enterprise value, and typically the deal is driven based on an enterprise value based multiple like EBITDA. The sources and uses schedule has a uses side that's based on purchase enterprise value, minimum cash, and transaction fees. Once again, I'll pull it up and you can see it right here. Purchase enterprise value, fees, and minimum cash. And then the sources side is based on debt and investor equity in an LBO. And in an M&A deal, it's based on cash, debt, and stock. And there might be a separate pool for the cash for transaction fees. The sources side is very standard though. There's nothing really notable or different about this just because you're dealing with a cash-free, debt-free deal. And on the balance sheet, the cash is wiped out and replaced with a minimum cash balance right afterward. and the debt is repaid and replaced with a new balance, which could be about the same or could be higher depending on the company and deal type. So here's our lesson plan for this tutorial. We're going to start with a very simple example of a public versus private LBO. Then we'll move into a more complex example with a full 3-statement LBO model, and I'll show you the typical adjustments here and how a cash-free, debt-free deal looks a little bit different from a non-cash-free, debt-free deal. Then we'll go into a quick example for a public versus private M&A deal and really stay focused on the private M&A deal and how it's similar to and also different from the cash-free, debt-free treatment for LBOs. And then I'll explain in the last segment why cash-free, debt-free deals are economically equivalent to non-cash-free, debt-free deals. I'm not going to say on 100% of cases, but I think in probably 99% of cases, or at least in most cases, the vast majority of cases, they are economically equivalent. Let's go to the first part here and talk about a simple example of a private versus public LBO deal. The private deal is a cash-free, debt-free one. So in a private LBO, in a cash-free, debt-free deal, the purchase enterprise value is the driver, and we repay the existing debt and replace it with more debt. The uses side consists of the purchase enterprise value, the fees, and the minimum cash balance, and the deal funding, the new debt and the investor equity directly funds this minimum cash balance after the deal closes. So let's pull this up, and you can see here we're assuming a 12x EBITDA multiple, and the company has about 50 million in EBITDA, so the purchase enterprise value is 600 million. Let's go and link this in. The transaction fees here are going to be based on a percentage of the purchase equity value. So 1% times the 550 million. Then we'll add the legal and other fees. The financing fees here are typically based on the amount of debt that we're using. So we're using about 5x EBITDA for the debt here. And so the 250 million times the 2% fee will give us the financing fees in this case. And then the minimum cash balance is defined right here. It's a percentage of EBITDA. So we're saying 20% of EBITDA initially. Let's get the company's EBITDA right when the deal takes place in year 0. This is 50 million. 20% of 50 million is just the 10 million right there. And that's our total uses. Now on the sources side, we're using 250 million of debt to do this deal. And then the investor equity is just a plug. So we take total uses and subtract the new debt issued, add these up, and then let's do a quick check to make sure total sources equals total uses, and it does. And then if you look at the rest of this model, right when it starts, the initial debt balance is simply what we assumed up here at the top. And then the initial cash balance is simply what we have in the uses side here, the minimum cash balance for the company. And then you can see how these change over time as the company repays debt and as it accumulates more of a cash balance. So this is what a cash-free, debt-free leverage buyout for a private company looks like in a very simple case. If you compare this to the public company version with a non-cash-free, debt-free deal, the driver here is the purchase equity value. It's based on a share price premium, and you also replace the existing debt, and you have fees on the uses side. So let's go in and take a look at the public LBO tab right over here. This is based on a premium to the company's current share price, and purchase equity value rather than purchase enterprise value is the key driver. So equity purchase price of target, 550 million. The company has 100 million of existing debt. There are still transaction fees. So we're still going to charge a 1% advisory fee on the 550 million purchase equity value. We still have the legal and other fees, and then we have the financing fees. So here, the 2% times the 250 million of debt total that we're using to fund this deal. And let's add these up. Those are our total uses. And then on the sources side, the debt components are often shown separately. You'll have more categories of debt. You might show the assumed or replaced debt separately from the brand new debt that's put on the company. Excess cash also appears on the sources side, and there is no minimum cash shown on the uses side. So let's go in and take a look at this. For assume/replace target stat, we're going to link to the 100 right over here. And then for the new debt issued, we're taking the 250 and subtracting the 100 million of assumed/replaced debt, because this is really the brand new debt that's being issued and added to the company's capital structure. For the excess cash, we can take the company's cash balance up here, 50 million, and then we can subtract their minimum cash. So the minimum cash is 20% of EBITDA. We'll multiply by EBITDA in year 0. So we get 40 million of excess cash, and then investor equity once again acts as the plug. So we'll take total uses and subtract our sources so far, add these up, and once again, our total sources equals our total uses. Now this may look very different because the sources and uses are different numbers, 623 versus 663, but the investor equity is actually the same. 373 there, 373 here, and the new debt issued is also the same. It's 250 in the private company case, and here it's still 250, it's just that it's split up into different components. So although this looks quite different, ultimately the private equity firm is actually paying the same amount and is also using the same amount of debt to do this deal, even though on paper, one is a cash-free, debt-free deal, and the other is not technically. Let's go into a more complex example now with a 3-statement LBO model. The principles here are the same, but we need to tweak the balance sheet, the debt schedule, and the returns calculation based on the deal type. So on the balance sheet, we need to add the minimum cash in the cash-free, debt-free case and deduct the entire debt balance. Otherwise, if it's not a cash-free, debt-free deal, we're just going to deduct the excess cash balance. So let's go to our more complex 3-statement model right here. And you can see that with the sources and uses schedules, we're following exactly what I said before. The cash-free, debt-free case is based on purchase enterprise value, a minimum cash, and the fees, and then various types of debt and investor equity. The non-cash-free, debt-free case is based on the purchase equity value, refinanced or assumed debt, fees, and then on the sources side, we have debt, assumed or replaced debt. We have excess cash as a new line item, and then we have investor equity down here as well. Let's go down to the balance sheet and see how this differs. So we already have most of our transaction adjustments here. What's different is that here in the debit column, we need to do a check and we need to see if this is a cash-free, debt-free deal. And if it is, then we need to go down and we need to add the company's minimum cash right after the close right here. So we're going to debit this. A debit is an addition on the asset side. Otherwise, we'll say 0. And then on the credit side, if this is a cash-free, debt-free deal, then we need to go in and take the old cash balance right here and just remove this whole thing because it goes to 0 and gets replaced with the minimum cash balance in the cash-free, debt-free case. Otherwise, if it's not a cash-free, debt-free deal, then we go up and we can just link to the excess cash on the balance sheet instead. And so we have that. And then we can just add up all of these numbers and we get to our cash balance right here. And you'll notice that regardless of what we set this to, if we make it a cash-free, debt-free deal or a non-cash-free, debt-free deal, the result is the same because the cash balance after the deal closes is still the minimum cash balance, the 20 million. It's just that the setup here is a little bit different, but nothing fundamental actually changes. Now, on the debt, as I say in the notes here, we have to debit the entire balance if it's a cash-free, debt-free deal, or just the amount refinanced in a non-cash-free, debt-free deal and replace the old debt with the new balance, whatever it is. So let's go in and I'm going to do that check. If cash-free, debt-free, then we're going to go and go up to the total debt balance right here. Now, if it's not a cash-free, debt-free deal, then we're going to go over and go down to the refinanced debt here in cell K36. We have this, and right now it's set to the cash-free, debt-free case, so the entire debt balance goes to 0. That's why we have a 50 and then a negative 50 right here. For this next line in the credit column right here, we're going to do another check if cash-free, debt-free. And if it is, then we're going to link to the total amount of new debt used right here, the sum of D26 to D28. Otherwise, we'll go down here and link to the sum of D35 to D37 right here, the brand new debt that is being put in place. And we have that. And then we can add these up once again. And you'll see that if we change this and make it a non-cash-free, debt-free deal, the result is exactly the same. It's still 198.4 million after the deal closes. The only difference is that in this case, we have the possibility of assuming debt, whereas in the cash-free, debt-free case, it's just not possible at all. And then finally, for the common shareholders' equity right here, let's go up and start by writing down the seller's common book value or their common shareholders' equity, because that always happens regardless of the deal type. Then I'll do a subtraction and I'll check the deal type. So if it's a cash-free, debt-free deal, then we need to go and get cell K28 right here, the transaction fees. If it's not a cash-free, debt-free deal, then we just take the transaction fees from this other sources and uses schedule. This isn't really necessary because the fees are always going to be the same regardless of the deal type. But just to make sure this is proper, we're doing it like this. And then same idea with the credit column over here. We'll check to see if it's a cash-free, debt-free deal. And if it is, then we will link to the investor equity in this schedule. If it is not, then we'll link to the investor equity here. But again, these should be exactly the same. And then we can link this down. And now we can see that the balance sheet balances correctly. So far, there aren't really any substantial differences. And that's the main point that we're trying to convey here. The equity is always written down and replaced with new investor equity, but just in case something is actually different, we link to the different sources and uses schedules to handle that. Now, for the debt schedule, we need to check the deal type and link in the starting balances to the correct set of assumptions for that type. Again, all these should really be the same. We're just being a bit paranoid here by linking them to different places, but they really shouldn't be any different at all. So for this case, let's go up to the different debt assumptions and we'll link to either the revolver in this schedule or the one in this schedule. For the existing debt, this is one that is actually different. So this is a bit of an exception. If it's a cash-free, debt-free deal, this is going to be 0 because this has to go to 0. But if it is not a cash-free, debt-free deal, then potentially we could assume some debt. So this will be a non-zero number instead. For the term loans, once again, we do the check and then we go up and we link to either the term loans right here or the ones in this schedule. And then for the subordinated notes, same idea. If cash-free, debt-free, and we link to the one in this schedule, or if it's not cash-free, debt-free, then we link to the one in this schedule instead. And so we have that. So we have most of our model set up now. And really the last thing to do is to look at the returns calculations. There are no real differences here, but again, just in case there are some potential differences, we do want to link to different numbers for the investor equity to make these calculations. So let's go in and do this now. We need to calculate the multiple and also the IRR here. So for the multiple, we'll take the exit equity value, which is in row 258, and then we'll do a check if cash-free, debt-free, and then we need to go up and link to the appropriate investor equity number. So it's either the one here in cell D29, or if we are not dealing with a cash-free, debt-free deal, it's the one in D40 right here. For the IRR, it's going to be very, very similar. So let's take the exit equity value and then do a check if cash-free, debt-free. If it is, then we're going to link to cell D29 again. If it isn't, we'll link to cell D40, which contain the investor equity numbers, and then we'll raise this to the power of 1 divided by the year number minus 1. We have that. And then for this line about the cash flow to sponsors. So this is also quite straightforward. If cash-free, debt-free, then we're going to link to cell D29 for the investor equity, otherwise D40, and now we have this. Does any of this actually make a difference? Does the IRR change at all? Does anything about this change? The short answer is, if we go up and change this, no, not really. It's still a 20.4% IRR. The cash flows are all still the same. Really, the one thing that might make a difference here is if we assume the existing debt. So if I set this to yes, and in this case, the IRR actually does change. And this case is different because here we're using the same amount of new debt, but when we have assumed debt, effectively we end up using more debt to fund the leverage buyout. So the only way that we can actually make the results here different isn't really by changing it from a cash-free, debt-free deal to a non-cash-free, debt-free deal. It's actually by assuming the debt versus repaying and replacing the entire debt balance instead. For now, I'm going to change these back. That's pretty much all I wanted to say about the three-statement LBO model. With cash-free, debt-free M&A deals, it's really the same idea, and the sources and uses schedule looks about the same on the uses side. I'm pulling up an example right here. So here's an example with company A, the acquirer, and company B, the target. They're about the same size, but company A is slightly bigger. The uses side is still based on purchase enterprise value, fees, and a minimum cash balance for the target. The difference is that we calculate the cash, debt, and stock available differently, and we have to link it to the deal funding required. So if you go up and look at this calculation, essentially we're taking the purchase enterprise value and adding the target's minimum cash balance to it and saying that this is the total, or this will be the total amount of cash, debt, and stock that the acquirer needs to pay. So the calculations and the setup are a little bit different, but it's still the same concept overall. The cash used here is actually the acquirer's cash used if you look at the calculation, because the acquirer has 100 million in cash and an 80 million minimum cash balance. If you were to look at the public company version of this deal, you'd see that the differences are about the same as in a leverage buyout, where the uses side is based on the equity purchase price. We assume we'll replace the target's existing debt. We have fees. And then on the sources side, the main difference here is that the cash used looks like a different number because now we're listing the target's excess cash as a part of this balance. So the acquirer's cash appears here, and then the target's excess cash also appears here. So it's framed a little bit differently, but ultimately the acquirer is still paying the same amount for the target, even though it looks different on paper. So the last topic I want to go into here is the equivalence of cash-free, debt-free deals with non-cash-free, debt-free deals. So the short answer to this question is that these deal types are equivalent because you can always rewrite the purchase enterprise value as purchase equity value plus debt minus cash. Let's go back to the simple example and show you what this looks like right here. So let's go to our private LBO tab and go down and just add some lines here so I can show you exactly what this looks like. So instead of purchase enterprise value, I'm going to rewrite this as purchase equity value and then targets debt and then targets cash. Let's go up and change this to the purchase equity value right here. And then for the debt, we'll add the 100 million. And then for the cash, we'll subtract the 50 million. So far, our sources and uses are exactly the same. They still add up to 623 million because all I did was rewrite the purchase enterprise value here as the purchase equity value plus the debt minus the cash. On the uses side, therefore, this means that we have negative cash plus the minimum cash. And you can see that right here. We're subtracting the whole cash balance, but then we're adding the minimum cash balance. And what that really means, if you think about it, is that we get the negative of the company's excess cash balance on the uses side. So to write this out more explicitly, what we could say is targets excess cash right here. And all we're doing is adding the minimum cash balance that we calculated before. So let's take this and then add this number, and then we can delete the minimum cash right here. And again, it's the same. Total sources equals total uses equals 623 million. Just like in algebra, when you have a negative on one side of the sources and uses schedule, you can move it to the other side by adding that same term on both sides. So it's just like an algebraic equation. And so what that means is that we can take the excess cash right here, and then we can just add a line item right here and say targets excess cash. And we can add this on both sides to make it cancel out on the uses side right here. So let's do this, and we'll just flip the signs on these to turn it into a positive. And then we'll delete the excess cash right here. And we have to change the investor equity as well to subtract this excess cash. And now we can see that it matches up and it looks just like the public company case. So I just showed you how you can take a minute or two and transform a sources and uses schedule for a cash-free, debt-free deal for a private company into one for a more standard deal for a public company and how they're actually equivalent. Now, you might be wondering if there are exceptions to any of this. And the short answer is theoretically, maybe. If the acquirer or PE firm repays the target company's debt balance without putting new debt in place, for example, it might look different, but I don't think this really happens much, if ever, in real life. Also, if the excess cash remains even after the deal closes. So, for example, on the sources and uses schedule, if there is no excess cash involved in this deal at all, if it doesn't appear on this side, if there's no minimum cash and total cash on the uses side, if nothing like that happens, then theoretically this might look a bit different. But if you think about it, it's still about the same because the acquirer just pays more for the target's equity in that case, and then it gets the cash after the deal closes. So there is no real way around this. Either the cash is higher and the purchase equity value is higher, or the cash is lower and the purchase equity value is lower. So there isn't a real way to play tricks with the cash balance. Different levels just change the equity purchase price accordingly, and that's the real reason why these deal types tend to be equivalent, even though they might look different or seem different when you first come across them. We're at the end, so let's do a recap and summary. We started by going through the very simple public versus private LBO example, and we started with this file, and I did the side-by-side comparison between a public LBO and a private LBO. Then we went through the three-statement LBO modeling example, and most of what we looked at in the simplified version still applies here. The sources and uses schedules still differ based on purchase enterprise value versus purchase equity value, and then things like where the excess cash appears. Is it on the sources side, or does it appear effectively on the uses side because of the minimum cash requirement there? We then went through and I showed you how to adjust the cash and the debt and the common shareholders' equity, as well as the debt schedule and the returns calculations differently. Then we went through the public versus private M&A example, and you saw how it applies there. The main difference is that you have to be a bit careful about where the cash is coming from, the acquirer or the target. And then I showed you why cash-free, debt-free deals are economically equivalent to non-cash-free, debt-free ones in pretty much all cases. The bottom line is that you can always rewrite a sources and uses schedule so that it's based on either purchase equity value or purchase enterprise value. And as long as you change around the signs correctly and move terms to the other side in the right way, it will be equivalent and you can get to the same number for the total uses and the total sources. That's it for this lesson. Hopefully now you have a better understanding of how this works and why these deal types are equivalent and why the cash-free, debt-free deal designation doesn't actually mean that much if you have set up your transaction models properly.